Welcome back, everybody, for another deep dive. And today we're going to tackle something really interesting that you flagged for us. It's all about how the stock market reacts to the Federal Open Market Committee, the FOMC, those meetings where everyone's kind of, holding their breath to see what the Fed's going to do. So we're working with excerpts from a paper, and it's literally titled Informative Price Pressure. So, okay, think back. Have you ever noticed how the market seems to get all jittery right before a big FOMC announcement? It's trying to tell us something, don't you think?
It really is fascinating, isn't it? And this research that you sent actually found that the stock market's average return on the day before. Recent FOMC meetings can actually give us clues about how the market might perform over the next 2 years.
2 years. Oh, that's wild. So it's like the market's whispering about the future, and this informative price pressure thing helps us decode it.
Exactly. The idea is that before these FOMC meetings, informed investors, those with a deeper understanding of the market, are hedging their bets to protect themselves from any unexpected outcomes.
Okay, so they're just trying to minimize their risk. But how does that actually translate into, this sort of predictive power?
Well, it's all about their actions.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Imagine a scenario where there's a lot of selling pressure the day before an FOMC meeting. Now, this might actually suggest that these informed investors are largely holding long positions.
Wait, so they're selling even though they think the market's going up long term. That seems kind of counterintuitive.
It might seem that way at first, but remember, they're hedging. They're essentially taking a small, calculated risk to balance their portfolios just in case the FOMC announcement goes against their main bet, which is that the market will go up.
So by analyzing these, pre-FOMC moves, we're essentially getting a glimpse into the collective wisdom of these informed investors.
Precisely. This informative price pressure allows us to decipher whether they are on balance bullish or bearish about the market's future. It's like a sneak peek into their playbook.
That's incredible. It's like we're tapping into some kind of market intelligence network.
In a way, yes. But it's crucial to remember that this is just one piece of the puzzle when it comes to investing.
Right, of course. There are no guarantees in the market. Now, the research also pointed out that this predictability is even stronger when looking at intraday returns. So the market movements during the actual trading day, not overnight changes, are actually more telling.
Yes, it's as if the market is having a more open and dynamic conversation during trading hours. This is when information flows more freely, and we see more pronounced shifts in this informative price pressure.
So we're looking for those subtle movements within the trading day itself. Fascinating. But does this phenomena only apply to FOMC meetings? What about other big economic releases like the non-farm payroll report or the CPI data?
That's a great question. And the researchers actually investigated this as well. What they found is quite intriguing. They found similar patterns with other major economic announcements. It seems like this informative price pressure emerges whenever there's an event with the potential to really shake things up. It's almost like informed investors are subconsciously communicating their collective outlook through their hedging activities.
So whether it's FOMC meetings, non-farm payroll, or CPI data, we might be able to glean insights from the market's behavior the day before. That's a pretty powerful tool for investors, don't you think?
Absolutely. It's all about recognizing these subtle signals and understanding what they might be telling us about the overall sentiment of informed investors.
Now, I'm curious, could this apply to other events too? What about things like company earnings reports or even political events?
That's a fascinating question, and one that the researchers only briefly touched upon. They suggest that the underlying principle could potentially extend to any event that creates enough uncertainty to prompt informed investors to adjust their portfolios in anticipation.
So theoretically, this informative price pressure could be a much broader phenomenon than we initially thought.
Exactly. It could be lurking in all sorts of corners of the market waiting to be discovered.
That's really exciting. It opens up a whole new avenue of analysis. Let's dive back into the specifics of this strategy for a moment. If someone wanted to try and use this informative price pressure to their advantage, what would that look like in practice?
Well, first and foremost, It's crucial to emphasize that this is not a foolproof system. The market is incredibly complex, and there are always factors we can't predict. However, if you're interested in exploring this concept further, there are a few things you could do.
Okay, let's hear it. What's the first step?
Start by identifying those key economic events that tend to move the market. We've talked about FOMC meetings, non-farm payroll, and CPI releases, but there are many others depending on your investment focus.
So pay close attention to the economic calendar. Got it.
Then, on the day before these events, carefully observe the market's behavior, particularly during the trading day. Look for any unusual price movements or trading volumes that might suggest informed investors are hedging their bets.
So we're looking for those subtle shifts in buying and selling pressure. Are there any specific indicators or metrics that might be helpful in spotting these patterns?
Certainly. Technical analysis tools such as moving averages, relative strength index, or RSI and volume indicators can be quite useful in identifying unusual trading activity.
So it's a combination of understanding the economic calendar and utilizing technical analysis to spot those telltale signs of informative price pressure.
Precisely. And remember, it's all about identifying those subtle patterns and interpreting them within the context of the upcoming event.
This is all incredibly insightful. But before we get too carried away, it's important to reiterate that this is a complex concept and requires a solid understanding of both market dynamics and technical analysis.
Absolutely. It's not something to jump into blindly. However, for those who are willing to put in the time and effort to learn and understand this phenomenon, it could potentially add another layer of insight to their investment strategy.
It's like you said earlier, it's all about deciphering those market whispers. And the more we understand those whispers, the better equipped we are to navigate the market's twists and turns.
Couldn't agree more. It's a continuous journey of learning and discovery.
Now, you mentioned that the research only briefly touched upon the potential for this informative price pressure to extend to other types of events. Do you have any personal thoughts or insights on that? For example, have you observed any similar patterns in your own experience?
Well, while the research didn't delve into specific examples beyond those major economic releases, I've certainly noticed some intriguing parallels in other areas. For instance, I've noticed that in the days leading up to major product launches by large tech companies, you often see a similar pattern of heightened trading activity and subtle price fluctuations. It's as if informed investors are positioning themselves ahead of the announcement, hedging their bets based on their expectations of how the market will react.
That's really interesting. So it's not just about economic data, it's about any event that has the potential to significantly impact a company's stock price.
Precisely, and I think that's where the real potential of this informative price pressure concept lies. It's about recognizing that informed investors are constantly evaluating and reacting to information, and their actions can provide valuable clues about their collective outlook, regardless of the specific catalyst.
So whether we're talking about FOMC meetings, earnings reports, product launches, or even geopolitical events, this framework could potentially help us interpret market movements with a new level of understanding.
Absolutely. It's all about expanding our toolkit for analyzing market behavior and recognizing those subtle signals that might otherwise go unnoticed.
Well, this has been an incredibly fascinating deep dive. I feel like I've gained a whole new perspective on how to read the market.
It's always rewarding to explore these less traveled paths of market analysis.
To our listeners, we hope this deep dive has sparked your curiosity and provided you with some new insights into the fascinating world of market dynamics. Remember, it's all about paying attention to those subtle whispers and using them to inform your investment decisions. Until next time, happy investing.